All right. Hello, everybody. This is Mike Rixey. I am the lead options instructor for Netpicks, and this is our options trade of the week. We're going to take a look at volatility here today, specifically using VXX. That is one of the volatility ETFs that we like to track. We're going to start out by taking a look at a chart of the actual VIX, symbol VIX, and that's what you're looking at here on the chart. This is a daily chart, and what I want to point out here, we've seen a massive rally in equities really the whole year, but we've seen a recent leg to the upside just over the past couple of weeks. And this week, we actually hit all-time highs pretty much market-wide. As a result, they have sucked all of the volatility out of this market. Volatility is now down near, historically, a lower end of the range. And what I'm talking about here is if you take a look at this daily chart, notice what happens anytime that we get down into that 11 to 13 range. You'll notice that the VIX starts to stabilize. We don't typically head much lower than that range. And it makes sense. If you start to get volatility this low, what that's indicating is that equities are super strong. We've seen a one-way move, and the entire market is all one-sided right now. Everybody is bullish. Everybody is expecting this market to head higher. And in many cases, that's when the market likes to catch people off guard. Volatility, when you get this low, it's very difficult to get it to head much lower than this because in order to have it in market, we have to have buyers and sellers. There's very few sellers right now. Everybody is a buyer. For this to normalize, we're going to need to see equities pull back, need to see some selling, and if that happens, the volatility is going to start to expand. Anytime that I see the VIX at an extreme, in this case, it's to the downside, in the 11 to 13 range. On the upside, an extreme would be the high teens, low 20s. Anytime you get there on the upside, you'll notice we had a couple of stretches earlier this year where we got up into the upper teens, low 20s. Notice what happened. It lasted a couple of days, and that's it. When you get to these extremes, it gives you an opportunity to take advantage by putting on some new positions. So we're seeing an extreme on the downside. We're approaching an extreme. We haven't seen any sign of volatility expansion as of yet, but you'll notice on the trade that we're going to structure today, we have some flexibility. We have some leeway here. Just in case we are a little bit early, we can structure a trade that puts the numbers in our favor. So now let's switch on over and let's take a look at symbol VXX. You can see that we've been in a pretty impressive downtrend here. No doubt about it, this market is oversold. And because of this move to the downside, I'm expecting price to start to stabilize in here. Not saying this volatility is going to expand immediately. Not saying it's going to explode higher. We don't need it to. All I'm looking for with this position that we're going to talk about today is a move sideways, a period of consolidation, or a move higher. And let's start to piece this together. So let's go over to the trade page. And let me bring up VXX. Now, this is going to be a longer term position, meaning I'm not going to trade the weekly options. Not going to be ultra aggressive there. I'm just going to go out a little bit further in time, and we're going to go out to the August monthly options with 35 days left. We're doing that because I am not certain on the timing of this trade. We might be a little bit early. We could see this market make one more push to the upside into early next week. We've got earnings season ready to kick in with a lot of the financial names releasing their earnings next week. We could certainly see one more leg to the upside. If we're a little bit early, I want to give ourselves time to be right. Give ourselves time to be patient just in case this market needs a little bit more time to reverse. So we're going to use the options with 35 days left to expiration. If I wanted to place a bullish bet on the VIX, the first option that I would have is just to come in and buy a call option. The problem with that approach, number one, it's going to tie up more capital. If I go in and buy an in-the-money call option, if I buy the 21 calls, we're talking about $250 per contract. They're liquid. You won't have any problem getting filled on those trades. The problem there is you only have one way of making money. If you buy a call option on VXX, you have to have that market move to the upside. That's the only way that you make money. If it's not a big enough move to the upside, if it takes too long to complete, you're not going to make money on that position. I don't want to be that aggressive. I want to be a little bit more conservative here. I'm willing to give up some profit potential in exchange for multiple ways of making money on the position. Another way to lean bullish is to come in and sell a put spread. So what I did, I came in and right-clicked on the 22 put. It's slightly out of the money. Right now, VXX is currently sitting right around 23. I'm going to right-click on the 22 puts, go to sell, and go to vertical. And that's going to pop up an order down at the bottom. Now, I can adjust these strike prices, which you can see I have done. I still want to sell the 22 put, but now I'm going to come in and buy the 20 put at the same time. That leaves me with a risk-defined trade. I know what my maximum profit potential is. I know what my maximum risk is. It leaves me with a better position given my style of trading and given my outlook for the market. It allows me to be more conservative. Right now, this trade is currently pricing in at 79 cents. I could collect $79 per spread, and that's the most I can make on the trade if VXX explodes higher over the next few weeks. The most I can make is $79. My profit is capped. Now, it doesn't seem like a large profit, but here's why I love the trade. Now, there's a couple of reasons. First of all, it's only tying up $121 of capital to begin with. Remember, we were talking about $250 to buy the long call. Now I'm able to lower that cost down to around $120 to sell the spread. Not only do we cut the costs in half, but we give ourselves multiple ways of making money on the trade. You'll notice my break-even point is at 21.21. I need price action to stay above that level. I don't care if it explodes higher. I don't care if it drifts higher, if it moves sideways. It can even move slightly against us. It can move all the way down to 21.21 before we are in trouble. The only move that hurts me is a big move lower on volatility. Well, we've already mentioned, I think we're at a lower extreme. I don't think the VIX can move much lower than what it's currently sitting at. This trade right here, it's a risk-defined trade. I can't lose any more than $120 per spread. And if I am absolutely dead wrong and volatility does make another move to the downside, I know what my max loss is. It's a much safer position. So up, down, or sideways, I can make money on the position as long as it stays above 21.21. I make money from time decay adding up. Now all of a sudden, every day that passes, the time decay helps me. It helps me make more money. I also make money if volatility decreases. So I give myself 5 ways of making money on the position. Only tying up $120 of capital, you can trade this with multiple spreads. You can put it on 10, 20, 30 times, just depending on your account size. At only $120 per spread, pretty reasonable regardless of your account size. Why am I willing to risk more and to make less? If I'm risking $120 to make $79, why does that make sense? Because we give ourselves 5 ways of making money on the trade. It's going to leave us with a much higher winning percentage long term. Doesn't guarantee I'm going to win on this trade. It just means there's a lot of factors stacking up in our favor. Right? So this is one way that I like to stay active in the slow summer months, especially with this market at an extreme. I think there's an opportunity here with some of these overbought and oversold markets. With today's trade on the VIX, we'll see what happens over the next few weeks. We'll see if the equity market will start to roll over and see if volatility will start to expand here as we go into earnings season. If you can't get filled on this today, the nice part about going out to August, you should be able to get into this trade early next week as well. Shouldn't have any problem getting filled Monday or Tuesday next week. As always, if you have any questions on this trade, let me know. Feel free to send me an email. My direct email is mike@netpicks.com, or you can leave a comment either on the YouTube video or in our blog post, and we'll get back with you right away. So I'm going to start to wrap this video up here. We'll be back with you guys next week. We'll take a look at all of our open positions using the trade of the week, and then we'll take a closer peek at a newer position going into next week. So enjoy your weekend, everybody, and I will talk to you all next week.